One of the best ways to build wealth is by investing. But a lot of times, people think investing is really complicated, but it can be pretty simple. Let me explain. Welcome to VA Money Matters with Ty. I'm your host, Ty, and I'm on my way to becoming an accredited financial counselor. And on this journey, I just want to share with you guys knowledge and tips when it comes to personal finance. Today, we're going to be talking about one of my favorite things to talk about: investing. Before we get into it, I would like to say I am not a financial advisor and I'm not your financial advisor. Make sure you reach out to a professional that can assist you with your specific needs. This video is for educational and informational purposes. Let's get into it. So in today's video, we're going to cover what is investing, when should you invest, and how to invest. And towards the end, I'm going to share with you guys one of the simplest ways to invest that has really been beneficial to myself. So let's get right into it. What is investing? Investing is putting money into an asset or project with the goal of earning a profit or income. A lot of people like to say it's better to let your money work for you instead of just sitting. This is a very, very true statement. This is how the wealthy think. Instead of having your money just sit into a savings account, a lot of people like to put their money in investment vehicles that can really give them a better return on their investment or money. Investing is how people build off of money that they already have. You might have heard of investing in places like real estate, investing in the stock market, bonds, or investing in startup projects. These are all places where people put money in hopes to get a return. Today, for this video, we're specifically going to be talking about the stock market because I want to share with you guys some of my experience. As someone who has been investing in the stock market and real estate, I really think I can give you guys a few tips that I learned the hard way. And we're going to start with one of my biggest lessons learned the hard way, which is when to invest. So let me give you guys a little bit of history. Before I started, doing this channel, I had another channel where I specifically talked about the stock market and things like that starting off. And I was really heavy into the markets. So I started really taking control of my own investment assets about 5 years ago. I started getting into the markets. I started moving money around in my own retirement account. And the reason being was because I was paying for a service where, someone manages your accounts. But I learned that a lot of times they're just doing the basic things with your accounts that you can do yourself if you have a little bit of knowledge. So I gained a little bit of knowledge and I was able to outperform what I was paying people to do just by having a little bit of knowledge. So I took over my own retirement account. I started moving my money around and things like that. So that money, again, it grew. It's still good. But I started investing on my own in my own brokerage account and things like that. But I didn't do one of the things that Dave Ramsey's team says to do. Before you start investing, of course, you can invest in your retirement accounts. You have to start that. As soon as you get a job, you should be investing in some type of retirement account, right? Because the earlier you start, the better. But when I started investing on my own, I had a simple brokerage account. And with a simple brokerage account, you can put money in, you can take money out as often as you need to. So when I started investing, I didn't do one of the things Dave Ramsey and his team recommends. I didn't have $1,000 emergency fund. In this book right here, this is Baby Step Millionaires by Dave Ramsey. It's a great read. And one of the things he mentions in there, and I saw it firsthand, is before you start investing, you should make sure that you have $1,000 emergency fund. Make sure you have all your debts paid off. And then make sure you have, 3 to 6 months of expenses saved up before you start investing. And okay, I'm like, man, I don't have all that set up, but I still was investing. I read that book after the fact, but it really resonated with me because I understood why. So back to my story, I started investing and my accounts grew pretty good. As I said before, I invested in real estate. When I first moved out of my mom's house, I got a house. I had a good job. I went on and bought a home. I bought a home, and as time went by, start building a family and things like that. I ended up renting the home out, moving in somewhere else with my current wife, my wife, I love her. But I moved in with her, and I put my house up for rent, and then eventually I sold it. Real estate is a great place to invest, but I would say that you have to have the mind for real estate. The renting process can be hectic if you don't keep it professional. And I would say professional so when I owned a home, I did a lot of the work myself, so I didn't have to come out of pocket. So you're either going to have to come out of pocket or you're going to have to be able to do the work. Before, I didn't have kids, I just had my wife, work. So I had time to work on the home. So I did things like put vanities up, put cabinets up. I redid the carpet. I put flooring down. And again, 90% of all I'm telling you about, I did myself. I did the yard work. I did so much in that house. I learned how to do a lot of handyman things because I owned my own home. So when it got time to, keep having people rent out the house, sometimes you have lags in between. I usually can take it myself, but when me and my wife bought our own house and we started building a family, that kind of took priority. I didn't want to have 2 mortgages, not be able to pay them. So I simply sold the house, and it was a relief. It was a big relief. So that was one investment that turned out good. I sold it, but if I had a little bit more cushion, maybe I would have kept it, because now the housing market is crazy. In that same house, I probably could have sold it for double or triple. But again, family. So I encourage anyone that doesn't have obligations like family, doesn't have anybody but themselves, you really can get active, because I didn't have any of those worries until, the family takes priority. We had a new house. I didn't want any liabilities. So I sold it, but now I had this money. That's another reason I got into the markets. I had the money. I put it into the markets. Cool. Made money, took it, went somewhere else with it. In the time I was in the stock market, my investments grew nice. So if I look back at what I was investing into now, it grew. Some of the investments grew over like 130%, 100% in the last 5 years. But I made one critical mistake. I didn't have the emergency funds and the extra money stacked up. So the money was growing. It was good. We had baby number 1. Cool. I stopped putting as much money into my investing. All right. But we was good. And then we had baby number 2. If you don't know, if you aren't a parent, you wouldn't know this. But daycare and childcare is crazy. So it went to the point where we didn't have anything, didn't have any of these other obligations. I had plenty extra to put in this fund. It was growing. The investment was growing. Money was looking good, but times got hard. Prime example, daycare can easily cost about $250 to $300 a week per child. I had 2. So we're talking about what I usually would put into an investing account. Times got hard, and now I got daycare bill that is running $600 a week. Yeah, I don't have the funds to invest anymore. I wasn't able to keep investing because I had other obligations, and my investing had to come to a halt because went from no bills, and then, had the child care. We got a new vehicle because we needed, more space for the kids, things like that. So I would say all this to say, One of the best times to invest is if you're a young person, you don't have any obligations, invest. If you're someone that has grown kids out of the way, you don't have to worry about any unexpected fees or anything coming up, invest. To my new parents, sometimes it can be hard, especially if you're going to be learning that, you have these extra fees, you have the daycare, you have the after school care. It might get a little shaky, and it got shaky for me. One of the first things I did was when it started to get shaky, really shaky, again, $600 a week. We were paying more in childcare than in any other bill, more than the mortgage, more than the car note. But at the end of the day, you want to make sure that your child is good, secure. So we paid the cost for care, and it paid off. But again, I point this out to say, if you haven't started a family, my young people, it's no excuse for you not to be investing. The best time to invest is before you have all the obligations. So I share my story just to say this. I agree 100% with Dave Ramsey's book, and I would recommend that you have that cushion in place before you start investing. Dave Ramsey recommends you have that $1,000 emergency fund. Most Americans don't have that in reserve. So it'll be a smart move to have that in place. Also, pay off all your debt before you start investing. As you heard with my story, because I had a nice investing account and life started to life, when I got in trouble with finances, the first thing I did was pull my investments, right? Which is what it's there for, right? I made money off my investments, but I didn't get the full growth of my investment as I planned. I didn't plan on taking it that early, but life started to life. So I had to do what I had to do. So I also would recommend to have that 3 to 6 months worth of expenses in reserve also, because again, you don't want to get in trouble and have to pull your investments prematurely. Sometimes that can even lead to a loss, especially if you're talking about stocks and things like that. If you pull at the wrong time, you can end up losing your money or losing out. So once you have all those things in place, your debt's paid off, you have a nice cushion, then I would say it would be time to invest. But before we start investing, we have to come up with a plan. Before you start investing, you definitely need to know the purpose, the reason. Why am I investing this money? Is it for a short-term goal? Do I want to take a trip somewhere? Am I saving to put a down payment on a house? Or is it for the long term? Do I have a certain dollar amount I want to reach? Or do I have a certain amount of years, like till retirement? Do I plan on using this money at my retirement age? If I'm planning to retire at 59 and a half, and then you can pull your money. Do I plan on retiring at 60? These are the type of questions that you need to sit down and actually think about before you invest. I know everybody wants to make money, right? When you want to invest, everybody just say, I just want to make money. That's easy to say, but if you have no clear-cut goal, at what point will you say your investing was successful? You have to have a target goal so you can see when or if you hit that mark. So before you start investing, definitely have a purpose. Why do you plan on investing? Once you have your why, then you're going to know what type of investing account you want to open. I'm specifically talking about stocks right now. So if you want to start investing for retirement, one of the best places that you can put your money and start investing is an IRA, which stands for Investment Retirement Account. And the best type of IRA is the Roth. The Roth IRA is special because you pay your taxes up front. By doing this, when you are ready to get disbursements or take your money out, you don't pay taxes because you already paid your taxes up front. This is great for people that think that they will be in a higher tax bracket later on in life, which everyone that is working should be. If you're working a job, naturally you're going to progress and get raises. And if you're working a job, naturally you're going to get raises, you're going to get promotions, things like that. So it's a good chance that you might be in a higher tax bracket later in life, especially if you're an entrepreneur. So again, the Roth IRA is one of the best types of investment vehicles for retirement. As you guys can see, if you're investing for retirement, the Roth is really good. It's so good that the government has to put limits on how much you can put into your Roth. So if you are under 50, the max they allow you to put right now currently is $7,000. If you're over 50, they allow you to catch up. They want you to catch up. So they allow you to put $8,000 max contributions into your Roth. And again, this type of account is so good that the government puts limits on it. They do it for a reason, because people can really take advantage of the tax-free money that you can get at the end when you start getting your disbursements. But just like any investment retirement account, you can't start taking your money out of these accounts without penalty until retirement age, which is 59 and a half. So again, these are retirement accounts. And these type of accounts are great for people that want to put their money in somewhere safe for retirement, because you're going to be deterred from taking that money because you don't want to get those penalties. And depending on who you have your Roth IRA with, you can invest in things like stocks, ETFs, bonds, mutual funds, and many more. It depends on who your Roth IRA is with. Another type of account that is great for investing for retirement, it can almost go hand in hand with the Roth. The Roth is good because of the tax-free benefits during the end when you're pulling for retirement, in retirement. The 401k is also a great place to invest. And the special thing about the 401k is the company match. So a 401k is an investment retirement account that you get with your employer, and the employer agrees to match a certain percentage that you put into this account, which is awesome. I wish I had an account, all my stock market accounts besides my 401k, put a match to money that I put in. And a match is exactly what it sounds like. Free money. If I put $100 in, I'm going to put $50 to your 100. Things like that. Depending on who your employer is, some employers match up to 100% till a certain percentage. And again, this is the reason that the 401k is an awesome vehicle. And in your 401k, you can make some of the same investments in mutual funds, stocks, bonds. It all depends on who your 401k is with. For example, my 401k is special that it allows me to have a stock market account. So my money goes into this stock market account and I control it, right? So you know we winning. I'm winning. So I control what I do with my stock market account. And a little snippet on why I like to control my own stocks is because at one point I was paying someone that, is linked with the company to manage my account. But I quickly noticed that they were doing the bare minimum. So these management services, they manage a lot of different people. So they see a lot of different accounts, but at the same time, that really leaves everybody at this generic way of investing. I quickly learned that what I knew or the knowledge I had gained from the markets, I could do better, right? And simple things allowed me to outperform what that management service was doing for my account. So again, that's if you want to get knowledgeable with some of this stuff like investing. If not, a management service is fine. Again, seek out financial help if you need that help. But make sure you stay tuned, because I'm going to give you a simple way to invest that can be very beneficial. Very beneficial. All right, another type of investment account is a simple brokerage account. A brokerage account might be for the people that aren't trying to invest for retirement. They are investing for more short-term gains. And these regular brokerage accounts allow you to put your money in, invest in stocks. The only thing is, once you pull your money out, if you have had any type of gain, that gain is taxable. And that's the key difference between retirement investment accounts and regular brokerage accounts. You pay taxes when you sell an asset for a gain. All right. So just keep that in mind. So you got retirement accounts and regular brokerage accounts. A lot of people like to ask the question, who should they get a brokerage account with? Well, to answer this question simply, if you are with a specific bank or a specific company that offers investment accounts, it might be something to look into to check out what the banks that you currently deal with, what type of investment accounts they have, because it can easily link to whatever you have. It might be easier to transfer balances and things like that. And I would like to say I have a Charles Schwab account. I have a Merrill Lynch account. I have Robinhood account. I have Fidelity. I have a lot of different investment accounts. And one thing that I will say is having a specific brokerage doesn't make or break you. At the end of the day, it's all about you and your investment styles. So if you are a long-term investor, you're investing for a specific time, maybe years, especially for retirement, you definitely just care about having your money in a secure place. I just like to say that because it's a lot of debate out there about which brokerage account is better. They all do the same thing. Basically, they all do the same thing. You can quickly set up a brokerage account within like 24 to 48 hours. You fill out an application on an app or even, online, and you'll be approved within like 24 to 48 hours. Pretty simple. Now, I want to share with you guys a simple way to invest that I have found very beneficial, and I have made profits from this way I have invested. And it's simple. It's pretty simple. So first of all, I would like to say, if you don't know anything about the stock market, make sure you read up on it. Never follow advice anybody says about the stock market, because you definitely need to understand what's being told to you, right? Even if you sit down with a financial advisor or anybody like that, make sure you understand the information. I'm big on making sure that people understand what it is I'm telling them, because oftentimes I think that people overcomplicate things for just the sake of making themselves feel smarter. I really do think that sometimes things don't have to be complicated. Investing doesn't have to be complicated. Matter of fact, let me show you a simple way to invest. I'm talking about investing in something called an ETF, an exchange traded fund. An ETF, or exchange traded fund, is basically a fund that you can invest into in the stock market. This fund is made up of a collection of assets like stocks, bonds, commodities. There are a whole lot of different types of ETFs. The thing that I like most about ETFs is that ETFs are extremely liquid. If you want your money from your ETF, all you have to do is sell your stock and you have your money, right? Simple, extremely liquid. It's not locked up into anything. You can take your money. And ETFs are great for investors that don't want to go and search the market for which stock is hot, when you should sell, when you should buy, things like that. If you just buy into the ETF is managed. Whatever company that the ETF is managed with, they will manage the basket of stocks, and they will make the best decision for their shareholders. Simple as that. I have won big off ETFs. And let me explain a little bit more about ETFs. So think of a basket of money. Everybody's putting their money into this one basket. The company or stock, whoever you're going with, the company that you're investing into is going to take your money and go handpick stocks and put money there. Everybody's money. And the mission is to grow the money, and in turn, everybody grows. So that is basically what an ETF is. It's a basket of stocks where people put their money, and then the company goes and picks stocks to invest in. The companies could invest in stocks like Apple, Microsoft, Google, all these big name stocks that if you went and bought yourself, the price of these stocks might be high. But because everyone has band together, it's easy to invest. Let me show you guys a couple of the ETFs that I on my channel had recommended and I was investing into myself. Check them out. Check out the 5-year growth on these ETFs. And these ETFs are simple growth ETFs. Over the last 5 years, these ETFs have grown over 100%. And it really was a no-brainer to go with these ETFs, because if you go to these ETFs, what you will see is that a lot of these ETFs are invested into these big name companies that we all know. Apple, Microsoft, Google, all of these companies we know are going to do well. It was really a no-brainer. And there are several ETFs out there that you can dive into that are based off the overall market. You guys have heard of the SPY and the NASDAQ. These are indicators of how the market is doing. And these ETFs are invested into those top companies in the SPY and the NASDAQ, and they easily grow. And to put this in retrospect, if I would have had $20,000 invested in the market 5 years ago, it grew over 100% without me having to put extra money in there. In just 5 years, it grew 100%. Now I got $40,000 and I didn't have to put any extra money in there. I didn't have to pay any extra payments. So that's 5 years. So let's say that 20 that turned into 40 in 5 years, it doubled again. Let's just say the market does great, and in 5 years, we doubling again. Then you have $80,000. In 10 years, you're $20,000. That's not you putting any extra money in. That's just money sitting. It has grown and it has doubled to 80. So in 10 years, you have 80. All right, let's say in 15 years, if that doubled again, you have $160,000 in 15 years. And again, this is just off 20. You didn't add any more to it. In 15 years, that's what you could have. And the potential of that doubling, I'm not sure, but let's just say if it did do it again, right? If it did do it again, you guys know we looking crazy. Times 2 in 20 years. In 20 years. And that's without you adding money to it. Now, if you added money to it, let's go back and see that. So first of all, let's divide 100% by 5 years. So that's 20%. That's your investment growing 20% a year to give you that 100. Let's see. There are plenty calculators out there, and I'm going to go to one real quick. Investment calculator. So I'm on a simple investment calculator. So we have 20,000. And let's say after, let's say we're going to go after 20 years. If it grew at 20%, just 20% a year, sometimes the market can go crazy. Say we add an extra $200 a month. So that would be $2,400 for the year. All right, so if we added that up just based off what it has done for the last 5 years and investing in something like the SPY-G, you would add that up. We added an extra $200 to our 20, and we did the same thing, kept it where it was at. Oh man, you guys can see the deposit amount in 20 years. Look at Diddy down there. So in 20 years by the math, just adding an extra $200 a month, $1.2 million. $1.2 million. And that's just adding $200 extra a month. And if this growth happened, I know what you guys are saying. It's not going to grow 20%. Okay, it's not going to grow 20%. Let's just say it grew 10%. The average market grows 10%. Let's just say it grew 10%. Let's see what we look like now. Big difference. But you're talking about $272,000 from $20,000 and adding $200 a month. I'm just saying, and that's money that you can access yourself. Now the 20% look better, but again, you can't argue with these numbers. And if you haven't started any type of investing in retirement, imagine if you put something like this in a Roth, and if you're young, you do it while you're 20, you have that much money in the bank at 40, and you get to keep going. So if you kept this up for 30 years straight, you would have $743,000. And don't even talk about if the market did grow as it was growing with 20%. Just saying. Oh my goodness. Sheesh. Oh my God. You talking about $7 million? That's craziness, right? That's craziness. But that's just if you can get these gains, and that's off $20,000. All right, guys. So that was a quick breakdown on how to invest. I hope I kept it simple for you, and I hope this video was beneficial for you. Oftentimes, people overcomplicate investing, but you don't have to chase stocks. You don't have to look for the hottest stocks. You can invest in a simple ETF and make profits in the stock market without the headache. I showed you guys from these stocks right here that it is simple to invest in an ETF. And if you trust the process, you can make profits in the markets. If you would like a coaching session on some of these basic terminologies and how to invest like this, please reach out. I am a financial coach, so I will happily explain things and help you so you too can invest and make profits in the market. Like always, I appreciate y'all checking me out. If you got questions, please feel free to drop them in the comment section. And let me know if you like this style of video by throwing up some likes. I appreciate you guys checking me out. Till next time. Peace.